You're about to hear how a fintech app convinced over 1 million people it was a bank. It faked audits, gamified trust, and locked over $312 million in user funds without ever breaking a single law. And how Mark Allen, a 38-year-old public school teacher from Ohio, lost his savings, then his confidence, and then something worse, his reputation. Keep watching, because what happened to him is already being rebranded and repackaged for you. Mark wasn't reckless with money, no crypto, no options, just an index fund and a rainy day account. But in April, he saw a post about an invite-only app called Monique. It promised direct yield, zero custody, total control. The deeper he got, the more it felt like investing. But what he was really doing was recruiting. Monique wasn't on the App Store. You joined through referral. A selfie and wallet link was all it took. No SSN, no tax forms. Just a Tier 1 KYC handshake, the bare minimum ID check fintechs use when they want speed over safety. KYC means know your customer. When it's soft, fraud gets in. When it's missing, fraud is the model. Once inside, Mark was assigned a trust velocity score of 72.4. He didn't know what that meant, but it came with a live balance meter. The app claimed he'd already earned $8.34 in soft yield. That score? It's how the funnel measured your influence and determined your worth inside the system. But what happens when the system gets too big? Monique called itself a self-custody neobank, a bank without being a bank. No FDIC, no physical branches. Just a Delaware LLC layered over a Cayman shell called Altura Pay, with back-end services from Estonia. Translation? Monique didn't hold your money. It just mirrored it and pretended it was growing. Mark invited 5 people, then 12, then 22. Each new referral boosted his soft yield rate, eventually reaching $41.05 per day. He wasn't earning interest. He was earning from velocity. The more people he brought in, the more he earned. The payout model felt like passive income, but it wasn't income. It was forward pressure. By month 2, Mark's dashboard balance showed $14,860. His cousin joined, his landlord joined, a few colleagues joined. Monique called it community liquidity scaling. But behind the scenes, all deposits were shuffled across wallet mirroring scripts with fake dashboards simulating yield. Wallet mirroring means your money isn't moving, but it looks like it is. It's a ghost trade. And just when it looked like Monique was taking over the finance world, it released a document that changed everything. Monique published a blog post. It read, Monique achieves Level 3 AML certification via LexNova Analytics. The PDF looked airtight. Audit stamps, legal jargon, compliance terms. Mark downloaded it, shared it with his union's finance chat. It looked real, but LexNova didn't exist. It was a ghost company, dissolved 2 years earlier. The audit was a template copied from a RegTech pitch deck and rebranded on Fiverr. AML means anti-money laundering. It's supposed to catch fraud. Here, it was used to simulate safety. Still, the audit didn't kill the hype. It supercharged it, and what came next felt like validation. But it was actually the setup. Monique announced a SPAC merger with a firm called Mercurio Pay. Projected valuation, $1.2 billion. User base, over 2 million. It hit TechCrunch, Yahoo Finance, and fintech newsletters. A SPAC is a shortcut to going public, and sometimes a fast lane to cash out before proving anything works. Mark felt safe. He moved his entire savings, $14,860, into Monique. He unlocked Obsidian Tier. He got access to Yield Boost Alpha, a visual projection promising $2,700 a month by the end of the year. He told his friends. 3 of them joined. 1 was saving for a home. Another was trying to pay off surgery. And that's when it finally happened. The animation stopped. The app froze. The silence began. Then a message appeared. Your liquidity is syncing with Mercurio layer. Access will resume post-reclassification. Clio, Monique's in-app AI assistant, stopped replying. Discord vanished. Reddit locked threads. No announcements, just emptiness. 3 days later, a push notification. As we transition into a simulation-only architecture, all balances are now reflected as NRPs, Network recognition points. These are non-cashable and represent historical engagement. Mark's 14,860, gone. His cousin's $3,000, gone. Over 1.2 million users affected. An estimated 42 million entered the system in the final 7 days before collapse. Simulation architecture means this isn't money anymore, just participation stats on a dead platform. But here's what's worse. There was no hack, no trial, no lawsuit, no compliance officer, no domestic custodian. There was no seizure, no charges, no restitution. Because technically, no crime had occurred. The money hadn't been stolen. It had been reclassified. Reclassification means your money has been renamed without your consent. And the new name? Points. Mark received a 1099 tax form in the mail. Monique reported his soft yield as engagement income. He owed $1,637 in federal taxes on funds he couldn't withdraw. That's when the reality landed. This wasn't a scam. This was compliance-colored theft, executed legally. What happened to the tech? That's the worst part of all. The new company is called Liftly. It offers financial simulation rewards for mindful money habits. Same badges, same UI, new logo, no memory. Mark deleted the app, but he still stares at the screenshots. Not because he lost his savings, because he gave away his credibility. He said, "It wasn't just my money, it was my trust, and I handed it over for a badge and a fake yield curve." Ask 3 questions anytime a finance app promises returns. 1. Is it FDIC or SIPC insured? If not, your money isn't protected, period. 2. Can you explain how the yield is generated in 1 sentence? If the answer includes referrals, velocity, or points, leave. 3. Do you know where your funds are held and who regulates them? If the platform avoids naming a custodian, they're hiding risk. Red flags to memorize, badges instead of balances, yield with no lending, fake audits from unverifiable firms, buzzwords like soft yield, simulated returns, trust tiers, and community scaling. If you see those words, you're not saving. You're being processed. Bottom line, if it looks like a bank but acts like a game, it's not your wallet they want, it's your belief, and they'll monetize that long before you realize it's gone. This was a fictional story, but the tactics are already real. Subscribe for more stories from the dark side of money.